Hi everyone, welcome back to the audit class and today's topic is risk assessment. So risk assessment has further sub parts, but today we will be discussing and focusing on audit risk. So what basically audit risk is? Audit risk is the risk that auditor may express the inappropriate opinion when financial statements are materially misstated. So it means that it is a risk with auditors that they have not audited the financial statements properly, or there are material misstatements which auditors have not identified. So it is the risk that financial statements are materially misstated. So audit risk comprises of two things: risk of material misstatement and detection risk. So if we see that audit risk AR is equal to RMM into detection risk, it is a sum of or multiplication of risk of material misstatement and detection risk. So here to simply to start with a simple thing, detection risk. What is the detection risk? So here it is the risk that procedures performed by auditor will not detect a risk which is materially misstated. So it is the risk with auditor that they will not be able to detect the material risk. So what are the function of effectiveness of audit procedures for minimizing the detection risk? So here it can be altered by auditor. So the other two RMM is can be altered by management and not by auditor, but the detection risk has the capability that auditor can alter this because it has certain inherent limitations, that auditor is not auditing 100% of transactions, and auditor is not auditing 100% of accounts everything. So there is a risk that certain areas or certain accounts or certain transactions are not audited, and the risk exists in that the misstatement exists in that particular transaction. So it is the auditor's responsibility and auditor's accountability for the detection risk. So detection risk is broken down into two further components. They are substantive test of details and substantive analytical procedures. We will discuss this further in detail in next chapters, but here for just overall understanding, to make you aware that detection risk comprises of two further parts, which is substantive test of details and substantive analytical procedures. Now to come to the RMM, back to RMM. What is RMM? RMM is is the client's risk, management risk, which exists independent of audit. Like auditor has not any role in the RMM. It's the client's risk, not the auditor's risk. So RMM is the something which exists at overall financial statement level as well as assertion level. Assertion level means transaction, balances, and disclosures. RMM at the assertion level consists of two further components, which are inherent risk and control risk. So we can say that RMM is combination of inherent risk and control risk. Now let's understand what is inherent risk and let's understand what's control risk. So inherent risk is the suspect to have suspicion on the relevant assertions to the material misstatement before consideration of any related internal control. It is inherently present in the accounts, it is inherently present in the financials, the material misstatement uh, related to any controls, any internal controls. For example, if we assume that there are no related internal controls, the inherent risk might be lower in that. So higher for the some assertions are if there are certain complex calculations, if anything is based on the judgment, or if anything is based on the estimates, which does not have any fixed formula, or which does not have fixed market value, but it is based on the auditor's judgment or specialist judgment. If we say that level 3 investments or anything such that which for which not a final market exists, and we have to estimate basis various judgments and various external factors, so it has higher risk of having inherent risk. It has higher chances of being manipulated, being materially misstated. So what are the factors? Entity and its environment, like external environment, has a huge factor in inherent risk. Like if inventory becomes obsolete rapidly because of technology, then inherent risk goes up, rises. If there are lack of sufficient working capital, then also inherent risk rises because of certain assertions. So these are certain examples which are the part of inherent risk. Now, what's control risk? Control risk is that entity risk that entity's internal control will fail to prevent or detect or correct the material misstatement on timely basis. So in control risk means has a risk that the internal controls that that's present in the company is not properly utilized, is not properly being used, because we are not able to prevent, detect, or correct the misstatement that may happen because of the lack of controls in the company. Function of design and implementation and operating effectiveness of internal control are affected by the management. Because the operating effectiveness of the company, the design and implementation of the control is the responsibility of the management, and it is impacted and affected by the management. So management has the possibility of altering the controls of the company. So, due to inherent limitations of the internal control, such as human errors or collusion, control risk can only be reduced but not be eliminated. That is why we do ICFR and internal control testings to identify that controls are in place or not. It is the auditor's responsibility to audit the internal controls, but it is the management responsibility to implement and design and implement the internal controls in the company. So that's about the two types of risk, RMM and detection risk. RMM consists of inherent risk and control risk, which are controlled by the management, and detection risk is something in the control of the auditor and not in the control of the management. So firstly, at the first sentence, we had discussed in the definition of the audit risk that materially misstated. So what the word materiality means here? The concept of the materiality is applied by the auditor with when both planning and performing audit, not limited to the planning, but planning and performing audit throughout the audit, and in evaluating the effective effect of the identified misstatement on the audit and uncorrected misstatement on the financial statement. So materiality is something which is applied by the auditor from planning till the completion of the audit of the financial statement, and it can be revised based on the misstatements identified. It can be revised basis the certain further aspects of the audit, certain aspects while auditing the financial statement. So what are there are various factors while considering materiality, like depending on the financial statement, depending on the company's background, depending on everything, like so materiality can be calculated using revenue, using PBIT, using in some cases expenses as well. So it depends from company to company, industry to industry, and depends on the financial statement and changes in the business as well. What are the misstatement? So misstatement is the difference between the amount, classification, or present. It can be in the amount, it can be the classification of the heads of the financial statement, or it can be the presentation and disclosure that has been reported in the financial statement that they are not correct. Like auditor has identified that management has used some old gap, or the practice of the management is not correct as per the standards. So those are the misstatements that are identified by the auditors. So misstatement may be because of fraud and error also. It can be error or it can be the genuine fraud. So both the cases comes under misstatement. Such as, for few of the examples are inaccuracy in gathering or processing the data, omission of the amount or disclosure, inappropriate selection or application of the accounting policies. These are certain examples of misstatement happening in the company. And misstatement can be further distinguished into three further parts: factual misstatement, judgmental misstatement, and projected misstatement. Factual misstatement, which are based on the facts and figures which are prima facie evident, which we can be identified from the prima facie of the financial statement that there is a misstatement in the financials. Judgmental misstatement arises from the unreasonable accounting estimates or selection of the inappropriate accounting policy. So judgmental misstatement happens from the estimates or the differences in the knowledge or different applicable of the accounting policies. Third comes the projected misstatement. So projected misstatement is because of the auditor's best estimate of the misstatement in the entire population based on the projection of the misstatement identified in the audit samples. So that projected misstatement is that if we have identified certain samples and we have identified the misstatement in two of the samples, so we will project that because of the two of the samples, there are chances that there may be further misstatement in the further transactions. So here it's based on the auditor's work, auditor's sampling check. We have projected that because there are misstatement in two or three of the samples, there are probability of having further misstatement. So this is how projected misstatement is identified. So I think that here comes the end of the audit risk. So to conclude, we have discussed materiality, we have discussed misstatement, and we have discussed the audit risk. Audit risk is a combination of RMM and detection risk. RMM is inherent risk and control risk. So to in precise, inherent risk, control risk, and detection risk comprises of audit risk. So I hope you understood this. And that's all for today's class. We will continue our next chapter, fraud risk, in next session. Thank you for staying connected. Let me know if you have any questions in the comments. Bye. Take care.